Hi, everybody. Hi, everyone. Excuse me. Hi, everyone. This is May Duldalau with YesFinanciallyFree.com. And today I'm going to be reading Chapter 2 of The Intelligent Investor by Benjamin Graham. And that chapter is called The Investor and Inflation. And the book is right here. So I'm excited to be here. I'm glad that you're here. And we will begin as soon as I give you a brief introduction of who I am. If you're seeing this for the first time, I have a blog, YesFinanciallyFree.com, and I put chapter 1 on my blog yesterday, and I put chapter 2 on right now, and I'm broadcasting live on my blog right now. But if you want to know exactly when I'll be broadcasting, what I'll be talking about, and hear lots of, I do blessings for people, financial, I give advice, I share life experiences, go to YesFinanciallyFree.com, put in your first name and your email address on the right side, and you get a free ebook, Working Parents Guide to Financial Freedom, and you get on my email list, and then you will hear all the news about what's going on with YesFinanciallyFree.com. Now, in this time, we're in this pandemic, and things are shut down. I actually have, with my husband, an Airbnb business that literally almost completely shut down, because tourism is like no longer happening in Hawaii, which is a huge deal for Hawaii. So you can imagine how many people have no jobs right now. They're wondering how they're going to pay their rent or their mortgage or their food even. And so I wanted to share a message of wealth and abundance with you so that you can lift yourself up. Instead of worrying, we replace that with knowledge, and knowledge on how to become wealthy in one of the most down markets we've had, right? And that's when people become super wealthy. So how do you do it? Well, I figure I want to know how to do it well, like Warren Buffett. And Warren Buffett studied Ben Graham, right? So that's why I'm reading this book. I'm doing it every weekday morning at this time, 8:30 a.m. Hawaii time, 2:30 p.m. Eastern time. I used to be really bad with money. In 2009, 2008, I started overspending ridiculously. I had credit card debt, which then I consolidated to loan debt. Then I got more credit card debt. And it was like this spiral. I did all this debt, ended up with over $40,000 of debt in 2011 and couldn't even pay all my bills. I went to credit counseling, all right? And I had a job at the time. I was a banking assistant, okay? So I wasn't even a full banker. Not that bankers make a ton of money, but I was an assistant, okay? So it's not, I wasn't in a high prestige job. I didn't make a ton of money. I made less money a year, like $35,000. My debt was $41,000, and $35,000 is before taxes are taken out, okay? So you can understand that was a lot of debt for me. Now, by 2012, I married my husband, who had even more debt. Right? He had six-figure, over $200,000 of debt. We had negative net worth, both of us. I had negative 30,000, right? He had negative over 200,000 net worth. When we finally, or negative 100 or whatever, six-figure net negative, we were both negative. But by 2016, we were completely debt-free. Not only that, in January of 2006, December of 2016, I quit my job and I started coaching Finance Freedom Mastermind programs. We are also making almost $500 a month in passive income every month. And we had improved our net worth by $500,000. In 2017, we went on 1 month of vacation. We went to Niagara Falls. We went on a cruise in Mexico. We went to visit relatives in LA, Toronto. We went to DC. It was an amazing time. I never gone on a cruise. It was one of my dreams. So I started making dreams come true. We bought our first home in Waikiki. We bought our second condo in 2018. That's the Airbnb business. Then we sold one home and upgraded to this home where we live now. It's a larger 2-bedroom apartment in Waikiki. And I'm sharing this with you to inspire you. You can really suck with money, okay? You can be bad, and then you can become really good with it. All right, so that's what I'm doing today. I'm going to be reading from this book, and I do this a lot. I am constantly learning more skills and tools to become a better investor, to create more and more passive income. During this economic downturn, even though our passive income has decreased, we still make passive income. What is passive income? It's money you make without spending any of your time. All right. Now, I want you to understand that you can create the skills to do that too, just like we are. And that's like we're constantly improving and learning more and more, right? Because when you first start, you fall down on your face, you get up again, right? It's like learning a bicycle. So I'm constantly learning, and I want you to learn with me. So that's how I do things. I'm a win-win kind of girl. Now, if you like what I'm saying, if you're jiving with it, if you think I'm a cool cat and you want to learn with me, then go to yesfinanciallyfree.com, put in your first name and email address on the right side, and get on my email list. You know exactly what I'll be doing. You can also view all my products there. We have the free ebook, which I already told you how to get, but we also have products ranging from $7 to $5,000, all training to help you become financially free as quickly as possible. And it's all there on yesfinanciallyfree.com. So check it out and bookmark it, and let's begin. Okay. So I'm live on Instagram, and I am also live on YouTube at the same time. So we're doing both. My Instagram channel, by the way, if you're on YouTube, is May Doodleow. Okay. All right. And if you're on Instagram, you want to know my YouTube channel, it's called Creative Abundance Now, which I know because we all create abundance in our lives right now, right? Okay. So thank you for being on today. We are excited. Chapter 2 of The Intelligent Investor by Benjamin Graham, The Investor and Inflation. So let's begin. And I'm really happy that you're here. Whether you're watching live or watching the replay, you're doing a lot for your brain. You know, I don't know if many investors have read this book, but let's begin. Warren Buffett has. It's good enough for me. The Investor and Inflation. Oh, by the way, like I said, if you missed chapter 1 and you want to hear me read chapter 1, go to my blog, yesfinanciallyfree.com. All right? Instagram, I deleted that video and I'm putting up chapter 2. But just so you guys understand that. Okay. The Investor and Inflation, chapter 2. Inflation. Hi, Janelle. How's it going? I'm reading from Benjamin Graham, The Intelligent Investor. Thanks for joining. Nice to see you. Oh, say hi to your cute little baby. Okay. The Investor and Inflation. Inflation and the fight against it have been very much in the public's eye in recent years. The shrinkage in the purchasing power of the dollar in the past, and particularly the fear or hope by speculators of a serious further decline in the future, have greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed dollar amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. On the basis of these undeniable facts, many financial authorities have concluded that bonds are inherently undesirable form of investment, and consequently common stocks are by their very nature more desirable investments than bonds. We have heard of charitable institutions being advised that their portfolio should consist 100% of stocks and 0% of bonds. This is quite a reversal from the earlier days when trust investments were restricted by law to high-grade bonds and a few choice preferred stocks. Our readers must have enough intelligence to recognize that even high-quality stocks cannot be a better purchase than bonds under all conditions. This is true right now. If you held bonds during this whole economic decline, your money went up in value. Okay. Regardless of how high the stock market may be and how low the current dividend return compared with the rates available on bonds. A statement of this kind would be as absurd as was the contrary one, too often heard years ago, that any bond is safer than any stock. In this chapter, we shall try to apply various measurements to the inflation factor in order to reach some conclusions as to the extent to which the investor may wisely be influenced by expectations regarding future rises in the price level. Right? In Hawaii, inflation is very high, especially for home ownership. A lot of young people and not so young people, cannot afford to even buy a home. Yeah. So inflation is much higher than it used to be for homes. In this matter, as in so many others in finance, we must base our views of future policy on a knowledge of past experience. Is inflation something new for this country? At least in the serious form it has taken since 1965. If we have seen comparable or worse inflations in living experience, what lessons can be learned from them in confronting the inflation of today? Let us start with Table 2.1, a condensed historical tabulation that contains much information about changes in the general price level and concomitant changes in the earnings and market value of common stocks. Our figures will begin with 1915 and thus cover 55 years, presented at 5-year intervals. We use 1946 instead of 1945 to avoid the last year of wartime control prices. Okay, so they have this table here in the book. Yeah? Table in the book. So let's read and see what he says, and then I'll see if I can show you the table too. Can we tell what the rate of inflation the first thing we notice is that we have had inflation in the past. Lots of it. The largest 5-year dose was between 1915 and 1920, when the cost of living nearly doubled. This compares with the advance of 15% between 1965 and 1970. In between, we have had 3 periods of declining prices, and then 6 of advances at varying rates, some rather small. On this showing, the investor should clearly allow for the probability of continuing or recurrent inflation to come. Can we tell what the rate of inflation is likely to be? No clear answer is suggested by our table. It shows variations of all sorts. It would seem sensible, however, to take our cue from the rather consistent record of the past 20 years. The average annual rise in the consumer price level for this period has been 2.5%. Official government policy has been strongly against large-scale inflation, and there are some reasons to believe that federal policies will be more effective in the future than in recent years. We think it would be reasonable for an investor at this point to base his thinking and decisions on a probable, far from certain rate of future inflation of, say, 3% annum. This would compare with an annual rate of about 2.5% for the entire period of 1915 to 1970. What would be the implications of such an advance? It would eat up in higher living costs, about 1/2 the income now attainable on good medium-term tax-free bonds, on our assumed after-tax equivalent from high-grade corporate bonds. This would be a serious shrinkage, but it should not be exaggerated. It would not mean that the true value or the purchasing power of the investor's fortune need be reduced over the years. If he spent half his interest income after taxes, he would maintain this buying power intact, even against a 3% annual inflation. But the next question naturally is, can the investor be reasonably sure of doing better by buying and holding other things than high-grade bonds, even at the unprecedented rate of return offered in 1970 and 1971? Would not, for example, an all-stock program be preferable to a part bond, part stock program? Do not common stocks have a built-in protection against inflation? And are they not almost certain to give a better return over the years than will bonds? Have not, in fact, stocks treated the investor far better than have bonds over the 55-year period of our study? The answer to these questions is somewhat complicated. Common stocks have indeed done better than bonds over a long period of time in the past. The rise of the Dow Jones Industrial Average from an average of 77 in 1915 to an average of 753 in 1970 works out at an annual compounded rate of just about 4%, to which we may add another 4% for average dividend return. The corresponding figures for the S&P Composite are about the same. These combined figures of 8% per year are, of course, much better than the return enjoyed from bonds over the same 55-year period. But they do not exceed that now offered by high-grade bonds. This brings us to the next logical question. Is there a persuasive reason to believe that common stocks are likely to do much better in the future years than they have in the last 5.5 decades? Our answer to this crucial question must be a flat no. Common stocks may do better in the future than in the past, but they are far from certain to do so. We must deal here with two different time elements in investment results. The first covers what is likely to occur over the long-term future, say the next 25 years. The second applies to what is likely to happen to the investor, both financially and psychologically, over short or intermediate periods, say 5 years or less. His frame of mind, his hopes and apprehensions, his satisfaction or disconnect with what he has done, above all his decisions what to do next, are all determined not in the retrospect of a lifetime of investment, but rather by his experience from year to year. On this point, we can be categorical. There is no close time connection between inflationary or deflationary conditions and the movement of common stock earnings and prices. The obvious example in the recent period, 1966 to 1970, the rise in the cost of living was 22%, the largest in a 5-year period since 1946 to 1950. But both stock earnings and stock prices as a whole have declined since 1965. There are similar contradictions in both directions in the record of previous 5-year periods. Inflation and corporate earnings. Another and highly important approach to this subject is by a study of the earnings rate on capital shown by American business. This has fluctuated, of course, with the general rate of economic activity, but it has shown no general tendency to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of the inflation of the period. To some degree, the decline was due to the charging of more liberal depreciation rates. See Table 2/2. Let me just go back and read that again. Another and highly important approach to this subject is by the study of earning rates on capital shown by American business. This has fluctuated, of course, with the general rate of economic activity, but it has shown no general tendency to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of the inflation of the period. Oh, I see. Okay. So they're saying that American business, what they have, their capital, has actually not increased with inflation, the value of it. Although there has been more liberal use of depreciation. Depreciation is the invisible factor in taxes and where they decide that your wealth is decreasing over time. And it is if you own real estate because it's getting worn out and you have to fix it and it's not worth as much in that sense. So that's depreciation. Okay. Our extended studies have led to the conclusion that the investor cannot count on much above the recent 5-year rate earned on the Dow Jones Industrial Average Group, which is about 10% on net tangible assets book value behind the shares. Since the market value of these issues is well above their book value, say 900 market versus 560 book in mid-1971, the earnings on current market price work out only at some 6.25%. This relationship is generally expressed in the reverse, or times earnings manner, that the Dow Jones Industrial Average price of 900 equals 18 times the actual earnings for the 12 months ending in 1971. Times earnings. So Dow Jones price of 900 equals 18 times the actual earnings for the 12 months ending in 1971. Okay. Our figures gear in directly with the suggestion in the previous chapter that the investor may assume an average dividend return of about 3.6% on the market value of his stocks, plus an appreciation of, say, 4% annually resulting from reinvested profits. Note that each dollar added to book value is here assumed to increase the market by about $1.60. The reader will object that in the end, our calculations make no allowance for an increase in common stock earnings and values to result from our projected 3% annual inflation. Our justification is the absence of any sign that the inflation of a comparable amount in the past has had any direct effect on reported price per share earnings. The cold figures demonstrate that all the large gain in the earnings of the Dow Jones Industrial Average unit in the past 20 years was due to a proportionately large growth in invested capital coming from reinvested profits. If inflation had operated as a separate favorable factor, its effect would have been to increase the value of previously existing capital. This in turn should increase the rate of earnings on such old capital, and therefore on the old and new capital combined. But nothing of the kind actually happened in the past 20 years, during which the wholesale price level has advanced nearly 40%. Business earnings should be influenced more by wholesale prices than by consumer prices. The only way that inflation can add to the common stock values is by raising the rate of earnings on capital investment. On the basis of the past record, this has not been the case. Okay, so this part I'm a little bit confused, but I'm going to keep going, okay? In the economic cycles of the past, good business was accompanied by a rising price level and poor business by falling prices. It was generally felt that a little inflation was helpful to business profits. This view is not contradicted by the history of 1950 to 1970, which reveals a combination of generally continued prosperity and generally rising prices. The figures indicate that the effect of all this on the earning power of common stock capital, which is equity capital, has been limited, quite limited. In fact, it has not even served to maintain the rate of earnings on the investment. Clearly, there have been important offsetting influences which have prevented any increase in the real profitability of American corporations as a whole. Perhaps the most important of these have been a rise in wages rates exceeding the gains in productivity and the need for huge amounts of new capital, thus holding down the ratio of sales to capital employed. Our figures in Table 2.2 indicate that so far from inflation having benefited our corporations and their shareholders, its effects have been quite the opposite. Well, that would make sense, because if there is inflation and they need to get people to work in their companies, then that inflation would create the need to make higher wages, and then you'll lose a lot of your profits because you have to pay people more money, and then you have to keep more capital on hand, right? And that the need for more capital will increase as inflation increases, because the amount of money that you have needs to increase to have the same effect. And that makes a lot of sense to me. Okay. So that's and they go through the different, in 1950, net corporate debt was 140.2 billion. And before tax income in millions was 42.6 million. After tax was 17.8 million. So that's an 18.3% earned, and 15% was capital and other data. But if you go to 1969, the percentage goes down to 11.8%, and capital is only 11.3%. So even though, and their debt is much higher, much, much higher than actually their income. So in 1950, it was 140.2 billion, and in 1969, 692.9 billion, which is almost 6 times higher. And yet, before income tax, earnings is 91.2, which is only like twice as much. So debt has multiplied much more than income. Okay. The most striking figures in our table are those for the growth of corporate debt, which is what I just said, between 1950 and 1969. It is surprising how little attention has been paid by economists and by Wall Street to this development. The debt of corporations has expanded nearly five-fold, while their profits before tax is a little more than doubled. With the great rise in interest rates during this period, it is evident that the aggregate corporate debt is now an adverse economic factor of some magnitude and a real problem for many individual enterprises. Oh, is that true? Gosh. Note that in the 1950 net earnings after interest before income tax were about 30% of corporate debt. Net earnings after interest was taken out were nearly 30% of corporate debt, while in 1969 they were only 13.2% of debt. The 1970 ratio must have been even less satisfactory. In sum, it appears that a significant part of the 11% being earned on corporate equities as a whole is accomplished by the usage of a large amount of new debt, costing 4% or less after tax credit. If our corporations had maintained the debt ratio of 1950, their earnings rate on stock capital would have fallen still lower, in spite of the inflation. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark the very fact that the unit cost of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their stockholders in the future as it has in inflations of the past. All of the above brings us back to our conclusion that the investor has no sound basis for expecting more than an average overall return of, say, 8% on a portfolio of Dow Jones Industrial Average type common stocks purchased in the late 1971 price level. But even if these expectations should prove to be understated by a substantial amount, the case would not be made for an all-stock investment program. There is one thing guaranteed for the future. It is that the earnings and average annual market value of a stock portfolio will not grow at the uniform rate of 4% or any other figure. In the memorable words of the elder J.P. Morgan, they will fluctuate. This means, first, that the common stock buyer in today's prices or tomorrow's will be running a real risk of having unsatisfactory results therefrom over a period of years. It took 25 years for General Electric and the Dow Jones Industrial Average itself to recover the ground lost in the 1929-1932 debacle. Oh, imagine how many years it's going to take for us to recover from this pandemic. Besides that, if the investor concentrates his portfolio on common stocks, he's very likely to be led astray either by exhilarating advances or by distressing declines. This is particularly true if his reasoning is geared closely to the expectations of further inflation. For then, if another bull market comes along, he will take the big rise not as a danger signal of an inevitable fall, not as a chance to cash in on his handsome profits. Did you cash in before this pandemic? But rather as a vindication of the inflation hypothesis and as a reason to keep on buying common stocks, no matter how high the market level, nor how low the dividend return. That way lies sorrow. Alternatives to common stocks as inflation hedges. The standard policy of people all over the world who mistrust their currency, tell me about it, has been to buy and hold gold. This has been against the law for American citizens since 1935. Luckily for them, in the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48. In early 1972, a rise of only 35%. But during all this time, the holder of gold has received no income return on his capital and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank, in spite of the rise in general price level. The near complete failure of gold to protect against loss in the purchasing power of the dollar must cast grave doubt on the ability of the ordinary investor to protect himself against inflation by putting his money in things. Quite a few categories of valuable objects have had striking advances in market value over the years, such as diamonds, paintings by masters, first edition books, rare stamps and coins, etc. But in many, perhaps most of these cases, there seems to be an element of the artificial or the precarious or even the unreal about the quoted prices. Somehow it's hard to think of paying $67,500 for a U.S. silver dollar dated 1804, but not even minted in that year. As an investment operation, we acknowledge we are out of our depth in this area. Very few of our readers will find swimming safe and easy there. The outright ownership of real estate has long been considered as a sound long-term investment. Unfortunately, real estate values are also subject to wide fluctuations. Serious errors can be made. In location, price paid, etc. There are pitfalls in salesmen's wiles. Finally, diversification is not practical. For the investor of moderate means, except by various types of participations with others and with the special havers that attach to new flotations not too different from common stock ownership, this too is not our field. All we should say to the investor is be sure it's yours before you go into it. Conclusion. That's interesting because they say when you partner up with other people to buy real estate, you're really becoming kind of like the same as the stock market because you're divvying up shares in a company with other people. So you're at the same risks as stockholders in a stock market. And I never even thought of that before, but I guess that's true. Yeah. Interesting, right? Conclusion. Naturally, we return to the policy recommended in our previous chapter. Just because of the uncertainties of the future, the investor cannot afford to put all his funds into one basket, neither in the bond basket, despite the unprecedentedly high returns that bonds have recently offered, nor in the stock basket, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against the unexpected and the disconcerting in this part of his life. It is axiomatic that the conservative investor should seek to maximize his returns. We think strongly that the risks involved in buying, say, a telephone company bond at yields of nearly 7.5% are much less than those involved in buying the Dow Jones Industrial Average at 900, or any stock list equivalent there too. But the possibility of large-scale inflation remains, and the investor must consider some insurance against it. There is no certainty that a stock component will insure adequately against such inflation, but it should carry more protection than the bond component. This is what we said on this subject in our 1965 edition, page 97, and we would write the same today. It must be evident to the reader that we have no enthusiasm for common stocks at these levels, 892 for the Dow Jones Industrial Average. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if we regard them as lesser of two evils, the greater being the risks of an all bond holding. So they don't believe you should carry all bonds, and they don't believe you should carry all stocks. They believe you should have both. And the reason that stocks are more important is because of inflation, even though it doesn't seem to perform that well, even with inflation. So I don't know about where they're going with that. Gold, because of the cost of storage. And this is true. If you want to start stocking up on gold, there are places where you can, but you have to pay for the maintenance of it. You can do nowadays ETFs that have gold valuations, which might be an option. The All Seasons portfolio that recommended by Ray Dalio has 7.5% in gold. And I have to admit that the Ray Dalio portfolio that I've been following for Jordan Savings, the All Seasons portfolio, and then I'm going to follow for Jamel's retirement, my retirement, it has 7.5% gold, 7.5% commodities, 40% long-term U.S. bonds, and 15% intermediate-term bonds. And then it also has 30% in stocks. So it's very low in stocks, 30%. And it has inflation hedges in it as well. So I understand exactly what they're talking about. And during this whole pandemic, Jordan's return is 2%. So he actually made money when most people lost most of their money in the stock market. Okay, so I'm glad you joined me today for the Investor and Inflation. I hope you enjoyed this chapter. We're going to continue on Monday, April 13, 2020, and we're going to do chapter 3, all right? And I will be summarizing this on my blog as well. So if you want to read the summaries, you can do that. YesFinanciallyFree.com. Okay, and my name, again, is May Duldalau, okay? And YesFinanciallyFree.com. That's the link in my profile on Instagram. And it's also I'm going to put the link to the blog under this YouTube video. Go there and subscribe to the email list if you haven't already. If you're on my email list, thank you for joining me. Please feel free to share this with your friends and followers on your social media accounts. Share it, subscribe to my YouTube channel if you haven't already, and bookmark my blog. And I hope that I can bring more value these coming weeks. I hope we all become more intelligent investors and create return, profits, and can profit other people with our wisdom and our knowledge and our growing abundance. So take care. Aloha. Have a beautiful day and see you again Monday. Bye.